Welcome back to Mortgage Insider Update for this week. Well, the roller coaster continues. We started the week off with OPEC Plus cutting production starting in May of this year, spurring at the beginning of the week inflation fears that have subsided a little bit as we've gotten into midweek. ADP just came out with their report this morning. ADP private payrolls throughout the United States and has a pretty good finger on the pulse of what's happening in job openings and new hires. So 142,000 jobs were created according to the ADP report for the month of March. So that's far lower than the 200 plus thousand that were expected. We won't get the official numbers from the Bureau of Labor Statistics until Friday, so keep an eye out for that, as well as the unemployment rate. We did see a slight tick up in February for the unemployment rate, so a tick up in the unemployment for March could be another sign of a weakening economy. So we're keeping a close eye on that as we get into the sunny month of April. Let's check out the chart. We're going to look at the 10-year Treasury, down 7 basis points, down to 328. So as we check out this chart, the 10-year Treasury has really come in unglued. Now this is after a huge drop and not really a pullback, but just kind of trying to find its footing as we got past the SVB and Signature Bank failures and a little bit further weakness here as we have now today breached below the Fibonacci retracement level. If we go a little bit farther back, you can see where, actually quite a bit ways back, that the current levels on the 10-year specifically have not been breached since they were above this in September 2022. So we've seen the run up from September into the higher rates in the fall of last year. This was representative of a time period where mortgage rates had hit 7% on Freddie Mac's survey. Since we saw that, overall interest rates have come down. They've peaked and valleyed, but this could be a really positive sign if interest rates start to break below this level and stay there. The problem with interest rates is they don't seem to stay anywhere. They can never tell when they're going to go up or down, and this last year's chart is a great example. The universal mortgage-backed security also improving. Now this works in the inverse of the 10-year Treasury interest rate. This is the price paid by investors for mortgage-backed securities secured through Fannie Mae and Freddie Mac. 8 basis point improvement today. You can see that in this chart, green is good. The prices are increasing. That means the overall interest rate availability to consumers has improved, but has not improved back to the levels from early February, which were the lows for this year. Let's go. We'll do a similar look back for 6 months. We can see that we're definitely making progress, but we had much better rates in late January, early February before the mortgage-backed security prices, meaning the interest rates are actually rising while the price to investors was falling. That was a very poor investment until the flights to security and investors bid up the mortgage-backed security prices starting right after the SVB and Signature Bank debacles. That creates liquidity in the securities market for mortgage-backed securities, and we saw that improvement in price has been resulted in improved interest rates to consumers. So we'll keep an eye out for the unemployment report this Friday and make it into next week, where we'll start to see more inflation numbers from CPI, Consumer Price Index, and see what other shoes there are to drop on the economy. Have a great week.